We'll look backwards in order to look forwards. For a lot of things, I think for both equities and fixed income, from the typical view is you start with equities and you work your way down. I kind of prefer to start with the fixed income side because ultimately 2025 was a great year for the fixed income space. We saw a lot of outperformance. We saw the Fed cut rates a couple of times. And ultimately credit spreads stayed about where they were and actually tightened a little bit. And so as a result, the Barclays Ag actually ended up in a plus or more than 7% positive territory, which is higher than what its coupon return would be. You look at that from a kind of an expectation setting standpoint for looking forward. The fixed income space really is fairly range bound in that it can't exceed its coupon forever. So when it goes above like that and we have a year, it kind of resets expectations for what you should expect to get from bonds and from rates on a go-forward basis. Now we're looking at probably coupon yields in the 4.5 to maybe 5% range if we're stretching into credit spreads. So expected return lower. What that means for equities then from a just comparable, risk plus type of scenario, it leads us to then say, all right, now our floor for what we expect to get from equities would also be lower as well, kind of from a build-up method. And that's pretty reflective too as to where things have gone and where we have been in the equity markets. Obviously, last year was another double-digit year for the S&P, up around 15%, 16% again. International equities did even better than that. Had a bang-up year. Finally had some what we've been calling for a while. I guess you call for it long enough, it'll actually get there. Then the internationals caught up. Still think that there's some room to run there, but you look at it on a backwards-looking basis. 3 straight years in double digits. Again, that's something that's difficult to repeat. In the axiom of sports, it's really hard to go back to back to back. We were just talking before off camera about the run the Patriots had. That's pretty rare. And even the greatest Tom Brady teams didn't win 3 straight. And to do 4 straight is almost unheard of. And so to do that within the equity markets, I think we could still see positives, and we could get into the earnings expectations if sort of the growth estimates hold and we don't see any type of multiple contraction, that we could probably see mid to high single digit type of returns in equities, sort of a return to normal. But that's kind of, I wouldn't necessarily say best case scenario, but it would require a pretty significant amount of expansion and further multiple expansion in order to get into that kind of 4th straight year of double-digit returns. So in other words, I would say for your clients, mute the expectations a little bit. I think that you could still look at things as being positive and have a good degree of, a positive outlook for both equities and fixed income, but just recognize that, repeating the recent past probably isn't going to be quite as, maybe as reasonable from a go-forward perspective. Earlier part of 2025, a lot of the analysts were calling for sort of a return to, a 10-year normal and looking at low single digits. Well, that sort of ended up turning on its head midway through the year. We had a pullback. If we recall, it seemed like a long time ago, but, with the tariff and ultimately Liberation Day announcements, part of April, we were down in not just correction territory, but almost bear market territory. And we were able to recover back to these positive returns. I'm not saying we could get back to that level again, but it doesn't take a lot of catalyst for us to return to that level at these valuation levels. We're really keen on pointing out that there's a CAPE ratio. It's a modified price to earnings ratio on a longer term inflation adjusted basis. And where that ratio is right now, it's about levels where we saw it in late 99, early 2000, right before the dot-com crash. Again, not calling for crashes, just saying that valuations are pretty rich on a historical level. So that means that when the rubber band stretches, it can go back fast too. We don't know when that catalyst is going to occur. So we could see positive, but there's also some, maybe some muted and, measured expectations to be managing risk along the way.